Volkswagen just made a decision that exposes exactly how Donald Trump's tariff strategy is reshaping North American manufacturing. The United States is losing, and it is losing big on its own turf.
Volkswagen will add an import fee on cars impacted by the tariffs, impacting Volkswagen as well. The company says this 25% increase will be added to the sticker price of their cars.
A quick 5-year return on investment. That was the political pitch to Canadians when Volkswagen got a massive subsidy to build an electric vehicle battery plant in Ontario.
The transition started quietly, hidden within corporate disclosures and diplomatic visits that did not initially grab attention. But when viewed together, these signals reveal a much larger story that goes far beyond one automaker's site selection. Volkswagen, one of the world's largest car manufacturers, has shifted billions in planned investment away from the United States and toward Canada. At the same time, U.S. tariff policy is tightening its hold on global trade. The timing is deliberate. The numbers are substantial, and the long-term consequences run deep within North American manufacturing. In January 2026, Oliver Blume, CEO of Volkswagen, told the German newspaper Handelsblatt that the company would not proceed with its planned Audi factory in the United States unless automotive tariffs were reduced significantly. That statement followed a clear financial disclosure. Tariffs had already cost Volkswagen $2.5 billion in the first 9 months of 2025 alone. Blume made the company's stance explicit, saying that under the current tariff burden, major additional investments could not be financed. That was not political messaging. It was a financial reality. At nearly the same time, Germany's economic minister visited Ottawa and confirmed that the German auto industry was discussing expanding its presence in Canada beyond the battery plant already being built. She noted that talks had advanced beyond general ideas and into specific numbers and operational planning. The contrast was hard to miss. On one side of the border, expansion plans were paused. On the other, discussions were accelerating. The core of that Canadian expansion is a large battery facility in St. Thomas, Ontario. Volkswagen committed €4.8 billion, roughly 7 billion Canadian dollars, to build its largest overseas battery Gigafactory through its subsidiary, PowerCo. Construction began in 2025, and production is expected to start in 2027. The facility is projected to produce up to 19 gigawatt-hours annually in its first phase, with expansion capacity designed to supply battery for up to 1 million electric vehicles. This was not a symbolic move. It was a foundational investment intended to shape an entire regional supply chain. The key point is that the Canadian project advanced while the U.S. Audi plant did not. Both decisions came from the same leadership. Both were assessed under the same global conditions. Yet the results diverged sharply because the incentives were fundamentally different. Tariffs are often described as a way to protect domestic industries by making imports more expensive and encouraging local production. In theory, higher import costs shift manufacturing inward. In reality, the outcome depends on how companies evaluate long-term returns. Tariffs act as a tax at the border, paid by importers, and those costs usually pass down to consumers through higher prices. When vehicle prices increase, demand can weaken rather than shift. In late 2025, Volkswagen's U.S. market share fell by around 20% in a single quarter. That drop was not caused by a sudden surge in domestic competitors. It reflected shrinking demand as higher prices pushed buyers to delay purchases or leave the new vehicle market altogether. For a company considering a multi-billion-dollar plant, the main question is not just whether production costs are manageable. The deeper issue is whether enough long-term demand exists over a 20-year horizon to justify the investment. In the United States, tariffs raise input costs while also compressing demand. Equipment, specialized parts, and imported machinery used to build factories were also exposed to tariffs. That combination reshaped projected margins and extended return timelines. Volkswagen's leadership indicated that under these conditions, large-scale U.S. investments no longer met internal financial requirements. A factory is not built for a single political term. It is designed for decades of operation, workforce growth, and supply chain development. When policy uncertainty becomes part of the equation, financial models include additional risk. That added risk can turn a viable project into an unworkable one. Canada offered a different setup. The St. Thomas project benefited from federal and provincial support, including incentives and infrastructure commitments from Ontario, reportedly totaling hundreds of millions of dollars alongside broader national strategies aimed at attracting EV manufacturing. In February 2026, Prime Minister Mark Carney introduced a $3.1 billion automotive strategy aimed at securing long-term investment. German officials described that framework as highly appealing. Beyond subsidies, Canada provides access to trade agreements that allow vehicles and components made there to reach multiple markets with fewer tariff barriers. Suppliers tend to cluster around major facilities to reduce logistics costs and improve coordination. This clustering creates what economists call industrial gravity. One major investment attracts many smaller ones. The St. Thomas Gigafactory is expected to directly employ around 3,000 workers and support up to 30,000 indirect jobs across the supply chain. Infrastructure upgrades, including roads, rail links, power systems, and water facilities, were developed to support the plant and future expansion. These assets remain in place for future projects, lowering entry barriers for other manufacturers considering the region. Meanwhile, the cancelled Audi plant in the U.S. represents more than just a paused project. It reflects lost jobs, missupplier contracts, and reduced local tax revenue. It also represents lost ground in the race to secure next-generation EV supply chains. Every plant that is not built creates a gap in future production capacity. Broader data supports this trend. According to Reuters, German investment into the United States dropped by about 45% year-over-year in 2025 as tariffs intensified. This decline reflects decisions across multiple industries, not just automotive. Capital tends to move toward environments where long-term planning is possible. When trade policies shift quickly through executive actions, planning becomes more difficult. This pattern extends beyond Germany. In January 2026, South Korea signed an agreement with Canada to expand cooperation in automotive manufacturing and explore EV opportunities. The deal specifically mentioned strengthening a Korean industrial presence in Canada. At the same time, both Germany and South Korea were competing for Canadian submarine contracts, tying industrial investments into broader diplomatic negotiations. Manufacturing commitments became part of larger strategic relationships. The consequences for U.S. economic leadership are significant. For decades, the United States attracted global capital through its large consumer market, innovation ecosystem, and relatively stable regulatory environment. Tariffs have begun to weaken these advantages at the same time. Higher prices reduce market size. Diverted funds limit research and development. Policy instability complicates long-term planning. Volkswagen's 2025 financial report showed that positive cash flow was partly supported by reduced spending on equipment, tooling, and R&D. When billions are absorbed by tariffs, those resources are no longer available for advancing battery technology, automation, or software systems. Over time, this shift can slow innovation. U.S. car dealers have also reported increasing hesitation from buyers as prices rise. When consumers keep vehicles longer, turnover slows. Lower sales volumes reduce dealership profits and feed back into manufacturer forecasts. A smaller expected market makes new factories harder to justify. The cycle becomes self-reinforcing. It is important to note that multinational companies rarely present site decisions as direct responses to specific political leaders or policies. Official explanations focus on workforce, infrastructure, and strategy. However, timing and financial data tell a clearer story. When tariff costs reach $2.5 billion in 9 months and a U.S. factory is paused while a Canadian megaproject moves ahead, the connection becomes evident without being explicitly stated. Canada's strategy combines incentives, regulatory stability, and integration into global trade networks. Ontario alone contributed around $500 million in direct incentives to the Volkswagen project, supported by infrastructure investments designed for long-term growth. These commitments signal reliability. For executives managing billions, predictability lowers investment risk. Looking ahead, more announcements are likely. As battery production grows in Ontario and supplier networks expand, additional manufacturers may see Canada as a lower-risk entry point into North America. Future statements may highlight skilled labor and cooperative policy frameworks. But the underlying calculation will still revolve around tariff exposure and stability. Capital shifts do not happen instantly, but they build over time. Once supply chains take root in one location, moving them becomes expensive. Training programs align with local industries. Universities develop research partnerships with nearby companies. Infrastructure improves around existing hubs. Momentum grows. For U.S. policymakers, the key question is whether tariffs are achieving their intended goal. If the aim is to boost domestic production, policies must increase demand while maintaining competitive costs. When tariffs raise prices enough to reduce demand while also increasing production expenses, investments may shift outward instead of inward. Volkswagen's move is not isolated. It reflects a broader shift across North America as companies weigh stability against uncertainty. The United States remains a major automotive market with deep capabilities. However, the direction of new investment carries both symbolic and practical importance. Today's investments determine tomorrow's industrial landscape. By 2027, Canada's EV sector could include multiple large-scale facilities anchored by the St. Thomas Gigafactory. Each new supplier strengthens the network, Each infrastructure upgrade reduces costs for future entrants. This compounding effect improves Canada's position in the global automotive supply chain. At the same time, delayed projects in the U.S. represent postponed opportunities. Communities expecting growth must adjust their plans. Workforce programs tied to future factories may need to change direction. Economic planning depends on certainty, and uncertainty makes it harder to achieve. None of these outcomes were guaranteed. They emerge from policy choices, financial realities, and global competition. Volkswagen assessed its situation, calculated returns under current tariffs, and chose a path that aligned with long-term profitability. Other companies are doing the same behind closed doors. Capital does not move with dramatic announcements. It shifts through financial models, risk evaluations, and board decisions. Over time, those shifts reshape industries. Canada has positioned itself to benefit from the current situation. While the United States faces growing questions about the unintended effect of its tariff strategy, the forces driving these changes are already underway. Incentives determine location. Stability determines scale. Demand shapes timing. When these factors align in one place more than another, investment follows. Volkswagen concluded that $2.5 billion in tariff costs, combined with policy uncertainty, made U.S. expansion financially unviable. Similar conclusions are being reached across industries affected by trade policy. What happens next depends on whether policymakers recognize these signals and respond. Corporate investment decisions are not emotional. They are calculated responses to costs, demand, and risk. When tariffs are used as leverage, they can unintentionally push companies to diversify away from the very market they were meant to strengthen. If this trend continues, North America's manufacturing map could look very different within a decade. The real question is how quickly U.S. leaders understand that persistent tariff pressure may be encouraging alternatives rather than preventing them. So where does this lead? Will the United States adjust its trade strategy to restore confidence and attract long-term investment again? Or will more global manufacturers quietly move expansion plans toward countries offering stability and incentives? Is this just a temporary shift in supply chains, or the beginning of a deeper structural change in industrial power across the continent? And most importantly, who bears the cost if investment keeps moving elsewhere? Companies, workers, or consumers? Share your thoughts in the comments, because these changes go far beyond a single company or factory. They affect jobs, local economies, innovation, and national competitiveness. If this breakdown helped connect the dots, consider subscribing for more insights into the economic forces shaping global industry. Turn on notifications so you do not miss future deep dives. Thanks for watching, and more detailed analysis